Hi, it's Steve Nielsen from Ascent Wealth Management, just dropping in before Easter with a few end of financial year tips for your planning. There have been a number of changes over the past few years with regards to superannuation, and this year there are changes to the superannuation contributions caps. The non-concessional contributions cap, which previously allowed you to put in $180,000 a year or no more than $540,000 over 3 years in one lump sum, have been changed. 180 has dropped to 100,000. So for this financial year, people are limited under the non-concessional cap to put $100,000 into super, but no more than $300,000 by bringing forward the 2 future years' contributions. The concessional cap has also changed, and that is the contributions that count towards the tax deduction that you may be able to achieve if you're self-employed, or the salary sacrifice and superannuation guarantee contributions for the employees. Previously, those over 50 could contribute $35,000 a year under this cap. That cap has dropped to $25,000 a year for not just the over 50s, but for everybody. It's important to realise that if you've made your arrangements based on a previous financial year's contributions cap, it's now time to actually make the changes to avoid breaching the new reduced cap of $25,000. The other thing that's changed is the spouse contribution tax offset that has been allowed. This gives a tax offset to a working spouse where they make a contribution to their non-working spouse super. The tax offset is $540 as a maximum, and that is given as a result of a $3,000 contribution to super. Prior to this financial year, the non-working spouse could earn up to $13,800 before that contribution, the tax offset was no longer available to the contributing spouse. This year, there's been some reduction, there's been some flexibility brought into the system. The non-working spouse can earn up to $37,000 before the available offset starts to reduce, and the available offset of $540 is no more once the non-working spouse is earning $40,000 or more. So it's a bit of a benefit for a change from the ATO. The next thing to consider coming to the end of the financial year is potentially bringing forward tax deductible expenses into this financial year, where that be possible. One example that comes to mind is prepaying interest on investment loans, such as margin loans or investment property loans, where that's possible, and that allows you to claim the tax deduction for the interest bill in this financial year rather than wait till next year. This could be a benefit for you in planning to receive other taxable income that you would not ordinarily receive in a tax year. The other flip side of that is deferring taxable income into the new financial year if that were possible also. Granted, for employees this is probably going to be difficult. This is more for the self-employed people who can have negotiations with their people that they're doing the work for to actually have them paid in the new financial year. So that's one that's probably got a bit of a niche about it. The other thing that comes to mind with regards to taxation prior to the end of the financial year is capital gains and planning to receive and realise those capital gains in the year that your assessable income is going to be lower. Say for example you were retiring after the 1st of July and wouldn't expect to have any more taxable income or very low taxable income for that financial year. It would therefore make sense to realise any capital gain in the new financial year. That way the assessable income that is generated through realised capital gains goes onto a year where you have not used much of your tax-free threshold and hence ultimately will pay a lower rate of tax. I talked about concessional contributions to super. It may also be, you may also be able to make some super contributions of one form or another under that concessional cap to further reduce the capital gain. Please see your accountant or financial advisor for further information about that, as those situations can be quite difficult to manage on your own. Lastly, I'd just like to remind people that are Centrelink pensioners that the gifting rules are something that needs to be taken into account around the end of the financial year. Centrelink allow $10,000 to be given away to reduce a pensioner's assets in a financial year, but no more than $30,000 over 5 years. 30th of June is a good time to remember what gifting has taken place to make sure you don't go over the $10,000 allowable limit in that year. If you do go over the gifting limit, the amount that you're in excess remains as an asset for you in terms of calculating your pension entitlements for up to 5 years. So it's important to get it right. That's about all from me. I'd just like to take the opportunity on behalf of Katrina and Troyden in the office to wish you all a very happy Easter. Hope you get some time away with your family and don't eat too many eggs. Look forward to catching up with you after we all get back. But in the meantime, have a great one. If you need to talk to us, please hit us on the web or give us a call on 07 3343 9228. Thanks very much.